Welcome back to Boring Currency Live with a major macro and policy update coming straight out of the United States. This is a significant development. The US Vice President just told a gathering of over 50 countries, all focused on expanding access to critical minerals, that the United States will establish a price floor system for key commodities. Reuters has since confirmed that the US is planning to implement this price floor mechanism specifically for critical minerals. This is huge news, folks. The global race for these minerals is accelerating, and it's official. Silver is now classified as a critical mineral. Before we dive into what this policy change could really mean for the market, let's take a look at what's happening right now. And once again, silver was rejected near that $90 zone and pulled back toward 83. That's a drop of roughly 8 to 9% from the highs. And just like yesterday, this sharp move happened during the New York trading session. We saw silver post a dramatic reversal, falling nearly $9 per ounce in less than 3 hours. Gold followed the exact same pattern, dropping around $220 per ounce in under 3 hours. So the question is simple. What pattern are we seeing emerge here? So far, silver has not managed to secure a daily close above $90. When we look at the broader trend, it's clear that rallies tend to form during the Asian and European trading hours, only to be followed by aggressive selling when the New York session opens. This pattern is becoming very predictable. Before we continue, just a quick note. About 75% of the viewers watching Boring Currency Live aren't actually subscribed. If this kind of real-time, data-driven analysis helps you cut through the noise and see both sides of the market, please consider subscribing. This channel is not about hype, it's not about moon calls, and it's definitely not about fear narratives. It's all about verified data and grounded, practical analysis. Your support helps us keep bringing you this content. Now, let's get back to the charts. In our previous analysis, we identified resistance around the 150-hour EMA, which sits near the $96 to $97 level. The current price is hovering around $86, which puts silver roughly $10 to $11 below that key resistance point. The pattern is becoming crystal clear. Silver rallies overnight, likely on global physical demand, and then reverses sharply during US trading hours as paper markets take over. Yesterday, it ran up to $90, then fell back. Today, we saw the exact same thing happen. That $90 level is acting as a very strong resistance, and the New York session continues to be where the significant selling pressure appears. We'll be watching closely to see if this pattern holds, or if the bulls can finally break through. Have you noticed the strange action in the silver market lately? Something big is happening, and it's creating a massive disconnect between East and West. Let's break it down. For 2 days straight, we've seen a clear pattern. Physical buyers in the East are accumulating silver overnight, pushing prices up. But as soon as the US market opens, paper selling takes over and hammers the price back down. Right now, Western spot and future silver are hovering around $86. But look at Shanghai. Spot silver there is near $102, and futures are around $101. That's a staggering $16 premium, almost 19% higher than the Western price. The price was rejected hard at $90, fell to 83 and has recovered a bit, but this New York selling pressure is impossible to ignore. Now, let's connect this bizarre price action to a major policy shift. The US government is implementing a price floor system for critical minerals. And yes, silver is on that list. This changes the entire market structure. A price floor isn't for paper traders on Wall Street. It's designed to protect and incentivize real physical production. Think about it. If paper prices crash below the cost to actually mine the metal, the floor doesn't follow the paper price down. Instead, the paper market is forced to adjust upward to meet the floor. That isn't a rally in the traditional sense. It's a fundamental repricing of the entire asset. This brings us to the critical question very few people are asking. What happens if the government sets this silver price floor above the current paper price? Imagine the government declares a price floor of $90 or even $100, while the paper market is trading below that level. The mechanism is simple. The government becomes the buyer of last resort at that floor price. This forces the paper price to rise and meet the floor. Now, while this would be unprecedented for precious metals in recent history, it's not a new policy idea. The US already does this with oil through the Strategic Petroleum Reserve. Now, critical minerals are getting the same strategic treatment. The implications for silver are just enormous. And the physical market data is already screaming a warning. In just the first 4 days of February, a massive 14.8 million ounces of silver delivery notices were issued at the COMEX vaults. That's nearly 3,000 contracts worth of physical silver. To put that in perspective, at the end of January, the total open interest for the February contract was just over 200 contracts. Yet within 2 trading days, the amount of silver demanded for delivery was more than double that number. This tells us that new, serious buyers are entering the market, demanding immediate physical delivery of the metal, and then getting out. They aren't just rolling over paper contracts. They are taking the actual silver. This is why the open interest number looks low even as physical deliveries are exploding. This is highly unusual, especially for a month like February, which is typically a quiet, non-primary delivery month. The big delivery months are usually March, May, and July. But here we have February posting nearly 15 million ounces in just 4 days. When you combine the relentless physical demand from the east, the strange selling pressure in the west, and a new government policy that could set a price floor above the current market, it creates a very explosive situation. The signals are flashing red. Something has to give. We all see the day-to-day price swings, but what's happening underneath is far more important. Physical demand for silver is relentless, and it doesn't care if the paper price goes up or down. Now, here's a crucial metric that puts this into perspective. The one-year silver swap, when you subtract US interest rates, is showing a market imbalance that is even bigger than what we saw during the 2008 financial crisis and the massive silver peak in 2011. Let that sink in. The structural stress in the silver market has reached historic extremes. This isn't just a small crack, it's a fundamental pressure point building up. At the exact same time, what are central banks doing? They're on a gold buying spree like we've never seen before. Countries like China, Russia, India, and Turkey are leading the charge. For the first time in history, central bank gold purchases have officially surpassed 5,000 tons. This creates a massive price-insensitive bid in the market. They're not day trading, they're accumulating for the long haul and don't care about short-term volatility. This adds a solid foundation under the gold price. Meanwhile, let's look at the broader market landscape. It's a sea of red. Risk is being sold off everywhere. Stocks are falling, oil prices are climbing due to geopolitical tensions, and even the crypto markets are feeling the pressure. Market sentiment is shaky and unstable across nearly every asset class. Yet, through all this chaos, global physical demand for gold and silver remains incredibly steady. People around the world are still buying the physical metal. So, let's cut through the noise and get to the core takeaways. What does all this mean for you? First, and this is a big one, the US is actively moving toward creating a price floor system for critical minerals. And guess what? Silver is on that list. This isn't just speculation or a market rumor, this is stated government policy. A government-backed price floor fundamentally changes the entire dynamic of a market. It puts a safety net under the price, altering the risk-reward calculation for everyone involved. Second, let's look at the comics. We're seeing physical silver deliveries absolutely explode, and it's happening in what's normally a quiet, non-primary delivery month. The demand for actual physical bars is more than double the open interest. People aren't just trading paper contracts, they are standing for delivery and taking the metal out of the vaults. This is a clear sign that the paper market is being challenged. Third, a very clear short-term pattern has emerged. We keep seeing silver get pushed down, or rejected, near the $90 level during the New York trading session. But then, overnight, strong global demand from Asia and Europe consistently pushes the price right back up. It's a tug of war. The paper markets and the structural physical realities are pulling in completely opposite directions. This leads us to the big, unresolved question: timing. When does this tension finally break? Does this pattern of rejection at $90 continue until the government's price floor mechanism is fully in place? Or does the overwhelming physical demand simply swamp the paper supply before that even happens? The short-term answer depends entirely on which of these powerful forces wins out first. But the long-term picture is becoming much clearer. The fundamental structure of the market is changing right before our eyes. As always, this isn't financial advice. It's crucial that you do your own research and due diligence, understand the risks involved, and make decisions that align with your own timeline and strategy. Invest with logic, not with hype. Thanks for tuning in. If you found this breakdown helpful, make sure to hit that like button and subscribe for more updates. Stay grounded and stay informed. We'll see you in the next video.